if you were saying, okay, I'm going to average over an extended period of time about 2% per month net, I think that would be a realistic approach to this. Now, at the moment, we're getting much, much more, but it is a very unusual time in the marketplace. It's a very good time to be in the marketplace, even for novices, because while the risks are high, because there's still a lot of volatility in the market, the returns are there as well. So if you don't go and mortgage the kiddies and throw everything you've got into the strategy, it's a very good time to be learning, because the type of returns that we're getting at the moment are paying back a lot of mistakes that novices are making. This is in addition to any capital growth and dividends you receive. You might remember one of the clients said, I've realised now that there are some months where you don't do the strategy. And there is generally months in the year where we don't do the strategy is when we're going to have a dividend payment, and the value of that dividend payment and the franking credits that are attached to it are more value to us than the premium that we'd receive. So if a company pays big dividends, they might be paying 7% for the year, fully franked. That's 3.5% for the month plus, for that particular month, plus the franking credits. We probably won't want to write a call that month. We'd probably want to keep those shares, pick up the dividend, and write the call as soon as the dividend is actually taken. So there are the only couple of times in the year where we generally don't do it. Volatility simply means that upward and downward movement in the market, and the higher the volatility of a share, the higher the premium paid. So for example, at the moment, the resource stocks are very volatile. They're very volatile on the upside. They're also volatile on the downside. But they're producing very, very high premium. So if our clients are prepared to take that risk, generally there will be resource stocks in their portfolio. At the moment, the banks are a little bit more stable, so they're producing slightly less premium, but they're a little bit of a defensive stock. And so generally, if our clients can afford it, we'll put that in their portfolio. To have a really good, well-balanced portfolio, you probably need to be investing about 100,000 plus. That's why we invented the fund, because a lot of our clients don't have 100,000 to invest, but they want to pass part of the strategy, they want to be involved in it, and that's why we invented the fund, because you can invest in that from just $5,000. This is my actual trading in September of this year. So last month, this is what I actually did with my own share portfolio and the portfolios that I manage on behalf of our clients. We bought BHP at $38.20. We wrote the October 09 $39 call, and we received 63 cents for that, which was 1.66%. And 19.92% annualised. CBA, we got 2.67%, 32.04% annualised. Macquarie, we got 3.65% for the month, which is 43.8% per annum annualised. NAB, we got 2.28%, 27.36% annualised for the year. ORI, we got 1.86%, 22.32% annualised for the year. Rio, we got 3.13%, 37.57% annualised for the year. WES, we got 2.24%, 26.98% annualised for the year. WPL, 2.89% for the month, 34.69% annualised for the month. So they're actual real live trades that I did at the end of the beginning of September. They're the actual ones that we got. Now, when you add all of that up and take out the cost of brokerage and all of that sort of stuff, the brokerage to buy the shares and the brokerage to trade the options, the net result of that was 2.67% for the month across that entire portfolio. 2.67% net of all costs. Who wouldn't mind be getting 2.67% net of all costs every month? It's not bad, is it? If you've got $100,000 to invest, ladies and gentlemen, you're earning $30,000 a year. Now, there's some people in this room, and I don't mean to be rude, who works very hard to net $30,000 a year. Very hard to net $30,000 a year. Some of you, if you think about it, those of you who put your hand up before and said, I've got a self-managed super fund and I've got a substantial amount of money in that, and I'm over the age of 55, if you get competent at this strategy and you've got $500,000 in your self-managed super fund, you do the maths. What are you earning in a year? 150,000, give or take. How much tax are you paying on that? Zero. If you've got $500,000 invested, you know, you can average $100,000 to $150,000 a year across an extended period of time. If it's in your self-managed super fund, you can set that as an annuity and you're paying no tax on it. This is what I call a beautiful thing. A beautiful, beautiful thing. So let's have a look at our Moo TV and find out the results that our clients are receiving in the market at the moment.
Since December 2008, I've committed a bit more money to the strategy. I built up a portfolio of 8 investment properties and sold 4 of those in Brisbane after the financial crisis. Took a little bit of a hit there, and reinvested 180,000 into the buy right strategy. That gave me a return of about $40,000 in 7 months, plus 4,000 in dividends. So that was about a 22% return in seven months. That was really fantastic. It was about 3 times the income I'd received from a rental property. So that was really fantastic, and showed me how good the strategy really is.
At the moment I have, I've got 2 contracts of Rio, and I've got 3 contracts with Macquarie Bank, and I'm looking at around about 5.5% return on both of those. Yeah, I'm very happy with the 5 to 5.5% return per month. That's pretty big.